and welcome to today's webinar, helping consumers navigate the financial crisis by boosting financial literacy and responsible lending. I'm Tony Salaxel, and I'll be your moderator for today. Before we get started, a few housekeeping items to attend to. First, if you've got any questions during the webcast, you can click the Q&A button at the bottom and submit your question. We'll definitely try and get through as many questions as possible. Also, we will be recording today's webinar, and an on-demand version of this event will be available to all attendees over the next few days. Now, without further delay, I'd like to introduce our panelists for today's webinar. We got Tonya Berglund, Head of Product Innovation and Open Data at Equifax. We have Chris Ellis, CEO Finder, and Richard Shanahan, Chief Product and Data Officer at TikTok. So let's get started. To kick things off, how about we start with one word to describe 2022. Let's lay the groundwork and let's understand, where the state of the economy is, where cost of living is. Give me your one word and then tell me why. Richard, you want to start first?
Yeah, I'm going to go. Can I use an emoji? Can I say grimace? It's a little bit of a grimace at the moment. I think we'll expand on that in the next section.
Okay. Yep. Tonya?
How about I add to the grimace with a little tongue out? And I would say unstable. And that's a combination of factors. And again, we'll probably talk through a lot of this, but in summary, it's to do with the economy, it's to do with interest rates, housing, weather, you name it. Particularly if you're in Sydney, you would understand some of that.
Yeah, absolutely. Chris?
I'm not sure I was thinking of another emoji for Richard's comment there, but you can imagine that one. I had probably the word sort of watershed, because it feels like there's a few from and tos. Tom just mentioned really going from a good period of low inflation, low interest rates, etc. The current 2022 has, I think, really seen that shift. We can talk about some of the drivers in a second of that. So that's kind of one area. Yeah. The consumer version of that is probably pretty much every traditional sort of investing asset class is less attractive right now. And the flip side is, pressure on household income, which will be a theme for the next hour, I suspect. Therefore, savings, less disposable income, etc., becoming, more the norm. So I think there's this year we've seen a kind of a shift from to that. And I think the other one I'd call out, which is interesting, particularly given I suspect the number of technology companies on the call, is the sort of emergence of Web3 and a sort of technology moving from a pretty, sort of big players, centralized web to the future promise of things like blockchain technologies and innovation that can bring in the longer term. So I think we're sort of on the cusp of that as well. But I suspect the first two are probably more relevant for today's call.
Yeah, absolutely. So then let's get a little bit deeper into that, I guess. That's a whole heap of things that you're definitely seeing out there. I can see that. So what then is, what are the drivers of those? Richard, maybe we start with you in terms of, with TikTok and what you guys are doing, what you guys are seeing. What are you seeing out there? What's the mood of, your customers, your consumers, but also your partners? What are you seeing out there?
Yeah, I think, if you look at those two big themes, it's the two I's, right? It's inflation and the monetary response, which is interest rates. And they are affecting, it's a double act, right? So we're seeing inflation, and I think Chris will unpack this a little bit more for us, but, especially if you look at the latest CPI data, you're seeing non-discretionary stuff, the stuff you need to spend to live, households, food, transport, really, really starting to spike, right? So that is eroding your household income while wage levels stay pretty flat. Now, add to that the response, the monetary policy response, which is the interest rates, that's cooled that down, right? So what you're seeing really, I'll take quite a lending focus here. You're seeing now some very interesting themes emerging. Now, we've all heard, topics around mortgage prisoners. I might just quickly unpack what that sort of looks like. So if you have a look at, take the latest April data, which is probably about 3 or 4 months old now. But if you have a look in there, in that last June quarter, around nearly a quarter of all deals approved had a debt to income ratio 6 and above. Right, so for every dollar you earn, you owe 6. Now that's a significant amount of debt. Now, a lot of this people you've probably heard in industry and through media, $500 billion of fixed rates rolling off. A lot of these people got loans when the market was in a different space, post-COVID, very buoyant, lots of purchases, fewer refis. People were coming on at hot rates, say the 2%. So now, when they're rolling off that fixed rate period over the next 12 to 18 months, they're going to go on to a much higher rate. Let's say, 4.5 to 5.2, and the interest rates aren't over. So for those people who had a debt to income at 6, they were spending maybe around 20, let's say 23% of their household income every month on servicing their debt. At the higher interest rate, that's now going up to around 40%. So these people are going to find that they're either going to be priced out of the market, they won't be able to refinance, and that's where the emergence of the mortgage prison is coming to the fore.
Yeah, that's very interesting. Tonya, you'd be seeing similar things, I guess, in your space. But what do you feel you can add to that in terms of what are you seeing out there? What do you feel the drivers are, and what are the mood of some of your clients?
Yeah, and look, the valuable part of it being a credit bureau, of course, is we see every bureau inquiry in Australia. And so just at a high level, to pick up on Richard's point around mortgage stress, what we've noticed over the last quarter is actually a decline in credit applications for mortgages. So mortgage lending and auto lending are actually down. So the home loan is around 6.1% backwards, auto lending 3.8%. So we're definitely seeing a decline in credit applications there. Having said that, however, on the flip side, unsecured debt with credit cards, buy now, pay later, personal lending, the credit card market, the increase in demand has gone up 31% this quarter. Buy now, pay later, almost at 10%, and personal loans at 22%. So what you're seeing is people still spending, but they're not investing so much in the housing market. Part of the reason as well that's driving that unsecured debt is people have got out of COVID and everyone wants to travel. Who would have thought? I know I definitely did that. They've all put their holidays on their credit cards, and they're spending like crazy. So just generally, we're seeing the demand there pick up quite considerably. So if we look at the macro credit demand, no, Chris has got some numbers here too. Overall, credit demand is at 17%, but that's, if I compare that to 2021, early part of 2021, it was at 28. So we're still not at peak levels, but it is still fairly high in that respect. And just, look, again, we'll talk through a lot of this, but there's extremely low levels of unemployment, 3.5%, which is the lowest in 48 years. Inflation, we've seen the fastest annual increase in inflation at 6.1% in 21 years. So it's crazy, the numbers out here. And we all know what is happening with the interest rates, particularly as we just discussed with the home loans. So you're going to see your variable loans rolling off, variable loans off already, but fixed rates as well, and people wanting to refinance. So the refinance applications will definitely go up. Definitely supply chain issues remain across industries. The auto loan industry, if anyone's tried to buy a car recently, it's a real headache. And household savings ratio has fallen about 8%. So there's just some numbers there, but you can still see the flavour of the economic environment is still difficult.
So I guess there's a lot of doom and gloom in that, Tonya, and on the back of Richard. Chris, why don't you give us a bit of a step out? Let's go out of credit lending. Let's have a wider look at the macro. Is there any good news from the macro lens?
Let's. I think the answer to that depends which time horizon you look at, actually. So let's chunk it back up a bit and then come back down with some numbers we're seeing as well. I think what's the best place to start? I mean, the interest. There will be, and we know this, there'll be more cash rate rises that will come through. And quite frankly, interest rates have to keep rising to dampen the demand point that Tonya just talked to. And you add to that, that means there's less money in the market to borrow, by the way. And the supply issue was referenced as well. That just the supply issue is not going to sort itself out anytime soon, right? Just look at China, etc. In terms of the approach they're taking to lockdowns, for example, cars, medicines, Apple, with their sort of Foxconn plant, etc. So that's, and that puts price that drives inflationary pressures on household items in that regard as well. So that's probably going to continue. So interest rates will have to rise, in my view, to kind of at some point dampen that demand. I've been in Australia for 8 years now, fully paid up Aussie citizenship wise, but most of my experience in Europe has been actually unemployment rising and greater defaults happening. Whereas here, when you've got the sort of unemployment rates you're talking about, it's essentially full employment at the moment. Whilst we see consumer sentiment dipping, there was some Westpac data out yesterday or the day before. I'll find a consumer sentiment tracker shows that the sort of consumer spending is still happening. It's still on the kind of rise, and to your point, travel is buoying that. We're spending, I think, more on restaurants and cafes now post lockdown than pre-COVID. So that's interesting. Although the signals are, there's going to be some retail pressures coming to Christmas, so that is going to be really interesting in the next 3 months. Actually, see how that flows through. But broadly, as interest rates go up, the cost of debt, goods will go up, and there will probably come a point where there's a bit more labour supply back in the market as a result of that as well, by the way. The challenge is that none of this really doesn't actually fix the supply side issue that we talked about, but it will mean that there's more efficient use of labour in the market as well. So from a consumer perspective, quite honestly, there are more pressures on household income, as we know. I think there needs to be some adjustments going on. As you know, asset classes, asset bubbles are basically bursting around the world. You can see what's happening to stock market, temp company valuations, etc. Private equity valuations, I think, are under quite a lot of pressure where they're highly leveraged, a bit less so in Australia, but there are pressures there. So there needs to be a sort of adjusting to the new cost of borrowing environment. And then from a consumer level, there's going to be, we're all probably feeling it. All of us are consumers on this call. And I think the call will go on to what we need to do to change that. But it's very, very interesting. Retail spend, I think, is now starting to come off. But we've still got strong levels. There's less wage growth, but we're in jobs in Australia. So, the income is there. But I think the mix is what's changing. So there's more now proportionate going to mortgages. Rents are high, energy, I think we'll all be aware of, petrol, etc. So I think near-term retail will adjust a little bit to compensate that, but next year is going to be very, very interesting. Let me just pause there. A few just to kind of stats, just to add some stats on that sort of finder side. We're seeing that traffic on the site, home loan traffic, particularly refi up, 23%. Our energy volume has doubled in the last quarter versus start of the year. So we're very, very sensitive. Savings in our, given the rates there, they're more interesting for customers as well. So really seeing that flow through day to day.
Yeah, I appreciate that. So I guess there's a few gems in there in terms of there is some light in terms of some of the bits and pieces, not all doom and gloom. So let's shift then. We've definitely laid the framework. I think we're all, as you said, mentioned, consumers on the call. We all understand the pressures that we're all facing or beginning to face. So how do we change it? So what are the tools financial institutions or business more broadly can help their consumers be? How do we get through this, and does business and fintech and financial institutions help their customers navigate these times? Is it technology? Is it what is it that you feel that we can do better? Richard, do you want to start?
Yep. Pick that one up. Yeah, so I think, really, I hope we've established those themes. Some really cool stuff there. Rate rises aren't over. The household incomes is going to continue to be eroded. The emergence of mortgage prisoners. So what does this mean for a business and for fintechs? There's the need to take cost out of your business as, you're facing margin pressures, and finding new ways to do things and improving the customer experience is going to become really, really important. So I suppose today, what are the tools? Are there adequate tools out there to support that? I think it's better than it has been ever. Are we at some sort of beautiful state? No, we're not. But I think we're really set up with some really foundational infrastructural stuff in the economy to do more. Now, I think there's some new thinking is going to be required from a lot of the incumbents and the new players in the market. Thinking about those things, how do you drive that customer experience, improve financial literacy? as an incumbent, how do you take cost out of your business? You can do the former. I think you might start seeing, and what I'd hope to see is we start using some of the traditional lending decision, again, I'll take a lending focus, lending decision weapons, around serviceability and decisioning and, even credit inquiries is helping to inform the consumer literacy. And you see that a lot today. There's a lot of companies out there, and probably a few people on this call who, provide a soft inquiry to your credit report, which Equifax or Experian. And that's really important information. What is your financial standing? If you think about the other key part of decisioning, which is very murky, very grey, but it's enshrined in lending regulations, takes serviceability. Now, serviceability really is just a function of your income, your expenses at a household level, and your debt commitments. But it's not that, it's quite, murky. So not all incomes are created equal, for example. Some of them are inherently more risky, are rental incomes, so it takes a discount. Your expenses are benchmarks or what you tell us, or what you validate in open banking data. It's a combination. And then your debt commitments, as a lot of people know, there's obviously a buffer, an interest rate buffer applied to protect you. So, what you think your net position is may not be what a lender thinks your net position is. So I think we can start looking at how we can democratize some of these traditional lending decisioning rules to help inform financial literacy. And it doesn't have to be like a point in time thing. When you apply for an application once every 3 or 4 years, you can do this as part of a nurture sequence. And I think this is where FinTechs are uniquely placed, a little bit less unencumbered, empowered by some great stuff emerging through the economy like CDR, to actually start rethinking financial literacy, and improving the economy as a whole.
Yeah, great answer. Tonya, let me take that in a different way for you. Let me just kind of point it a little bit more towards responsibility. So obviously, to Richard's point, there's different things that we can do. Whose responsibility is it to help consumers do that? Is it business? Is it the consumer's own? Is it us as an industry? Whose responsibility is it to help consumers manage their finances better?
Well, I'll caveat that with what type of finances you're referring to. So, if a bank's giving you money to buy a house, then it's the bank's responsibility to ensure you pay that money back. So you absolutely have to, as an organisation, even a FinTech as well, a TikTok would be very similar, have rules around your debts, the way that you finance your customers. And so, at the moment, particularly too, where you've got, potential interest rate increases, you're going to have to watch your arrears rate. And so the organisations, the businesses out there are really going to have to monitor how consumers are able to service their debt, to Richard's point. So that's definitely an organisational responsibility. But just your general day-to-day expenses absolutely have to be in the hands of the consumer. Now, the opportunity exists to have an app and have insight into how you're spending. And we see that at the moment with the availability of connecting our data into particular applications, seeing how an average PFM app might monitor how our income and expenses are performing and help us save for goals. And so there's some really interesting apps out there that can do that. I would say, however, that the problem, looking at this at a very high level, the problem I see is that whilst the capability is there, it's not integrated into the mainstream banking applications yet. So if you think about the great banked consumer in Australia, 85% are in the big 4 banks. And so that's 80 to 85% who may or may not really have access to a holistic view of their finances. And I would say probably most wouldn't. Now, the opportunity is there's absolutely the case, but whether consumers trust that they can actually connect their accounts in a secure way and then see and know that they can see all these things in one place is still something that we're trying to educate the market on. I think, a really good example, and I've spoken to a number of people who work with me at Equifax, and a lot of them say, do you know what? I didn't even know about a thing called a credit report until I actually started working at Equifax. And if you think about, even on the weekend, I was at a barbecue talking about what I do and credit reports, and people are looking at me going, why would I want to look at my credit report? Like, what? Whereas if I hazard a guess, if I was in the US, everyone knows their FICO score. So, just this example about financial literacy in Australia, we're almost deaf to the idea of the fact that we can get access to our credit report free and then have a number that we could potentially utilize to say, hey, we're actually really good in terms of our credit history. That may service us across, refinancing our loan somewhere else. But we as consumers don't seem to want to educate ourselves in this way, which is a really interesting thing. And so some of what we're looking at Equifax is all about financial literacy and helping people understand not just your credit report, but how you spend your money. And then also how to protect ourselves too in a secure way. Everyone probably would be conscious of the fact that there are data breaches at the moment, and we're very aware of what's going on, particularly Medibank at the moment is just horrendous. Optus before that. One of the things that Equifax provides is an alert capability that actually you can get free alerts if you're an Optus customer on any inquiry into your credit report history, or if anyone tries to apply for credit on your behalf with your name, you'll get an alert straight away. So you can track this sort of stuff. So these are the sorts of tools available, but we're looking at the uptake on some of these, and these are free pieces of information or advice we're offering consumers. It's actually really low. So it's super surprising how people actually don't necessarily want to know how they're spending their money, or even, around fraud alerts, which you think I would want to know about.
Give it time, Tonya. Chris, I definitely want to give you a crack at that one, but I want to kind of frame it a little bit different for you. So rising energy, petrol, food prices, obviously bill shock, very real in the finder world. You're definitely going to have a very, very different lens on that. So let me ask you whose responsibility is to help people manage their finances better, and then where's the duty of care line? Is it with us? Is it with guys like Finder? Is it with banks? So really unpack that one for me.
Such a good question. Let's have a crack at it in terms of my view. Actually, just to reiterate what Tony said, I should step back. We have a first-class media team that is on, Sunrise and did all these things, and sometimes it's quite hard to measure the effectiveness of that. When we talk about credit score, though, and just come to Finder, check it down, get your score. You can literally see the sort of spikes just by raising awareness on things like that. And a number of people on this call, just the more all of us do that, I think the better. It really is. And there's a nice payback for customers straight away as well. It doesn't take, you have to go through an application process for that. You can do it there and then. So definitely do that. I think about it in sort of concentric circles terms. I have to say, at the heart of the responsibility is the individual, us. I'll talk about other layers around that, but it's interesting because when times are good, quite honestly, the things we battle against most or spend a lot of time thinking about is apathy. There's a bunch of customers that, we've all done it, right? I know I should change, I'll probably get a better broadband deal, but it's either just too hard, which is one point, is actually there's a lot of friction in being able to do that, or frankly, the pain's not, I know I should, but I just don't get around to do it. We've all got things in our life like that. But I have to say that, individual and household level accountability matters hugely. Now, there are roles that other groups play around that. The next layer out, I would say, would be the providers, large and small, of services like this. And I think we'll talk a bit about, we spend a lot of time, we have a lot of people that are high intent customers looking to switch, or it's not just price, it's value, it's not just the price dimension. And therefore we spend a lot of time about finding a new provider. I think there's actually in terms of responsibility, I think existing, particularly financial services organizations, I think have I'm not sure the legal language on that, you use the word duty of care, but certainly there should be an expectation as a customer that your current providers really give you the best value product that suits your current needs. There's nothing worse than you find out you're on a tier that you shouldn't have been. But I think in the forward-looking world, the companies all win in the longer term will actually be prepared to move customers around to the right plan for them, be it broadband, be it a mortgage, etc. So I think there is a real responsibility that existing providers have. It's not just about switching. And then I think the third level is government. And I do think that government plays a role as an enabler. Some of that might come through regulation. I think we might talk about consumer data right as being an example of that, but there are other examples of that. I think there is a role to play in literacy there as well, by the way. So I think there's kind of different responsibilities there. The one final thing, it occurs to me as that we're talking about this, it perversely, and to Rob's grimace emoji, perversely, when times are a bit harder, we all feel more pain, and actually there is then more urgency to go and make sure your spend's going that a bit further. So you actually see higher volumes of people looking for savings now, and it's people are more aware when there's more pain in the market. I wish that sort of wasn't the case, because I wouldn't want those effects to be there, but we're seeing higher awareness right now based because of some of the effects we talked about earlier on the call. So yeah, that gives you a flavor.
Yeah, that's great. So I guess we're all agreed then that there's an effect, right? So there's definitely an effect on people's financial lives, definitely anxiety. Let's think about how we can help people better, understand the financial decisions that they're actually making. You did touch on the legal language of duty of care, but let's kind of go beyond that and say, all right, well, yeah, there's definitely regulation to protect us as consumers from bill shock, from some of the decisions that we're making. Maybe, Tonya, in your world, protecting us from ourselves sometimes. Do you feel like regulation goes far enough, or do you feel like maybe it goes too far to protect consumers?
Look, if I can, we've mentioned the Consumer Data Right a few times, right? And that's a highly regulated program in Australia. So let's touch on that. So the opportunity that brings with it is one of innovation. So there's the positive is there's a huge amount of innovation off the back of the Consumer Data Right, which allows a single view of an account, managing your money better, to what we were discussing, personalization of products. So there's huge opportunity there. The flip side is when you regulate something like that, it does become quite cumbersome to actually enable. And now working in an organization where we're going through the process of doing that, it's not fraught. There's a lot of angles that you have to cover in order to become compliant. And any organization that's gone through a data holder journey would probably be backing me on this one here too. I know the banks have spent millions becoming compliant as data holders. Is it overly regulated? Look, we're talking about consumer data and there's security around that. So I'd probably say no, because we need those rules to keep those safeguards in place. Accessing the data too, yes, we need regulation around it. But if I look at the US market, for example, which wasn't government regulated, it was a bilateral agreement situation. The rules existed between the market, not the government, and they came up with their own kind of decision points amongst themselves, and it still worked. Has there been any breaches in the US through open data? No, there hasn't been yet, because the APIs are controlled. It's a commercial agreement, and so you see two models which are still quite robust. One heavily regulated, Australia, one not so regulated, which is the US, and it's still working. So there is a happy medium. But, again, as I say, having been through the Optus problem at the moment and now Medibank, I think the sentiment in the market at the moment is we need regulation to protect us. And I think protection is extremely important. Cumbersome potentially, but also important.
Absolutely. Richard, give me your responsible lending hat. How far does regulation go? Does it go too far? Are we, especially given that the mortgage prisoners and the current interest rate position? What do you feel? Where are you looking at regulation at the moment?
Yeah, I might just touch quickly on echo some of Tonya's sentiments there as well. Just on CDR, like I'm TikTok. We've just been through our unrestricted data recipient accreditation, not the same quantum as a data holder, but it's onerous. But it's also it's good, right? It's consumer centric, and I think it is also paying back a little bit of, not sure what the regulation term will be, but like it's a bit of tech debt, quote unquote, in the economy in terms of how consumer data should be respected and treated and used. It's good, but the friction is still there every day, and we do see, and we want to see more data recipients out there in the ecosystem, people using CDR data for decision. But I think, like Tonya said, that accreditation pressure regulation is very present. And that does stifle a little bit of the uptick. Had we gone to a more bilateral engagement approach, maybe we'd be there faster. Don't know. I think we'll end up at the same point, but it's a journey we're going on. Responsible lending. Now, this is, it's a juicy one. I think just in principle, responsible lending is really making sure that, you are not putting hardship on borrowers as they progress 1 month, 2 months, 2 years down the track. In principle. Now, there's a lot of regulation and obligations that come with that need to be asked as part of the lending process. During the COVID era, there was some pressure to repeal a lot of the responsible lending obligations that were put forth, and definitely not to address some of the Royal Commission, Senator Haynes' recommendations. The Labor Party did come out, obviously, early a few months ago and said, that absolutely responsible lending is here to stay. It is absolutely critical to protect borrowers and the economy as a whole. And, that's great news for the economy because it is really important. We need to make sure we have a functioning economy and, that people aren't going to be entering into a bad debt situation, which is just anxiety laden and has terrible personal consequences as well. Could it go further? Yeah, absolutely. It could. Now, I don't know if we'll see it go further, but I think this is where, take one of the recommendations was around expenses. And if people understand lending today, expenses, there's a concept of the household expenditure measure. It's a benchmark based on your gross income, your dependence and marital status. It's like a lookup table, right? But that gets used as a benchmark to decision your expense position to produce a serviceability outcome, right? Now that is it's a little bit lagged in the economy, and in a high inflation environment, that's dangerous. It's also, we find when we look at the data for our platform, we find that probably about 83% of the time, your actual verified expense position is higher than your HEM benchmark. So could you have used real data, open banking data to automate expense positions? Absolutely, 100%. Now, would that have reduced borrowers and maybe underconvert? Perhaps, but you would actually have a more reflective and accurate ability to service debt on an ongoing basis. So responsible lending is multifaceted, but that's an example of how it could go further. I think the good news is it's here to stay in its current form. Will it expand? I'm not too sure.
Yeah, great insight. I appreciate that insight. Chris, let's kind of dig into that CDR topic just a little bit. Conscious it's quite a deep topic, but I think with the conversation today, talking about financial literacy and boosting financial literacy, how do you feel CDR will help? Can it help? Will it help raise the level of financial literacy? And will it enable some of the guys and guys and girls that are on the call today, and some of the businesses that are listening in, to provide the right tools to consumers to make sure that happens?
Yeah, if I make one high level comment on regulation, then go a bit deeper on the CDR.
Yep.
I think the example Optus, Medibank, I don't feel that regulation is a solve for that generally. That's about just cybersecurity. There's a whole bunch of things that play into that. I reckon every single board in its monthly board meeting will have had this topic as an agenda item, and I think everybody not at one of those aforementioned companies will frankly be thinking, oh goodness, thank God that's not us. We need to make sure we're absolutely robust. Let's audit again. And I suspect there's a lot of people nodding, hearing that comment. So that's kind of one comment. Now, on the role of regulation, I think does matter. So I think, actually, by the way, there are sectors that it's needed. We'll come back to CDR in 1 second, but an example would be crypto. And in Australia, that is a sector where most of the, let's say, good actor participants, would include ourselves in that, are actually requesting more regulation, because that would be an example of an emerging sector where we don't really have fit for purpose regulation. We're sort of retrofitting prior. So that would be an example where there is an absolute role for regulation to play at a high level, and allows the guardrails to be clearer, and actually then stimulates investment into the onshore investment and frankly job creation in Australia. So that would be an sector where I think regulation is needed, actually, at an accelerated pace. CDR, back to your question, we're just to declare, we're Finder was an early accredited data recipient, so we've been active in that regard. Actually partnering with some of the companies on this call, on the panel, and also I sit on the government's data standards committee. We actually had our monthly meeting this morning, so we're actively involved in that. CDR for me is fundamentally about choice for customers. It's I'm not even sure if I'd call it regulation. Maybe it is regulation, but it's really, the heart of that is, your data is yours first and foremost. We as companies talk about our first party data. Even that's a slightly strange expression, because actually the first party is the customer themselves. So anything that makes it, it just empowers customers to essentially choose who they share that with, and who they may wish to ultimately switch products or get a better experience, because that data enriches the service they may get from an existing provider. That to me is a very, very good thing. Now, the other thing I would call out, that from an Australian perspective, again, having moved out here from Europe, particularly the UK market, UK got ahead in open banking terms. However, their framework was really designed for that sector, whereas the CDR framework here is built as to be multi-sector, cross-sector from day one. So whilst I think it's taken a little bit longer to get to where are we now, I think in the banking side, I feel there's real critical mass of participants. I think the next wave is now use cases beyond account aggregation broadly coming through. I think the acts of initiation ability to write is a key part of that to really drive consumer take up. And we're on the cusp of that now, I think. So yeah, very pro that. And then I think the cross-sector point is we've got a framework that can move. I think now actually in November, we're just seeing the first energy companies coming on board, for example. We're talking about telco, Telstra and others have just joined the standards committee in the last few months, as well as the telco offload. So I think in terms of sort of the future proofing perspective, it's actually pretty well thought out. It's not easy on the implementation side, I would say, to Tonya as well. And those of us, it's a high bar to get accredited, maybe too high actually. But I think that the longer term direction is a very, very good one for Australia PTY.
And just to echo Chris's point around the sectors that are regulated versus not regulated, the buy now, pay later sector is one where, we've seen that just increase in demand over the last couple of years, and still continues at the moment. And it's particularly in that 18 to 28-year-old Gen Z bracket. And so what, of course, has happened is that the arrears have actually increased. And some of the larger banks, particularly too, who are looking at launching products around those lines, have been a little bit bitten by the fact that, the fraud actually too on those product lines have been quite high. And so that product, buy now, pay later, coming under the microscope from the government's perspective at the moment, and we will start to see, to the crystal ball question, the buy now, pay laters being regulated now and having to do credit inquiries on customers because they don't at the moment. And then the CDR question too. Look, gosh, where do you start? The opportunity is there, no doubt. I still think just generally it's much slower and the uptake. So there is definitely an increase in ADRs over the last year. The process is really cumbersome though, and complicated too, particularly with large entities like an Equifax is a really good example. But the opportunity back to that Gen Z market, if you use them as an example, the thin credit file customer segment, we call it in Bureau Land, which is the segment of customers who haven't had a history of credit, have probably had a job for a very short period of time. If you think about it, we often model, hey, there's a tradie and he's just started his own business, he's getting paid cash in hand and he'd like to get a home loan. How does that person get a home loan when they really are being 50%, dare I say, cash in hand, and basically don't have a long history of credit behind them? And so when you start to say, hey, let's flip this around and go, there's not just the credit report here that we can look at for thin customers. There are things like their transaction history in their bank account where it shows a steady income and it shows expenses not being too out of control, and there's no red flags, there's no gambling. And these are all things that you can start to see when you connect up your transaction account and then start to look at this in terms of credit. So these alternative data sources, which are really been a little bit on the edgy side for the traditional banking sector, are starting to actually rise to the top and go, we can actually start to create this financial inclusion of a market of and a segment of customers that potentially never had access to credit before. And so the opportunity here is huge. And, you know, we can still lend as an organization, knowing that we can see these ins and outs, you know, of the transactions that a consumer is either spending or acquiring through their income and their employer. But yeah, so there's an example that as we move to the future, what we potentially could see through the likes of CDR, not just from this holistic perspective of all your accounts in one place, but also using that data for good to improve not just the literacy, but also the uptake in lending behavior. And, you know, even just, you know, when we talk about how do we help consumers with the likes of CDR, I know I'm a classic example. I have a Stan account, a Netflix account. My subscriptions are out of control. If I actually could manage that and action it, even more importantly, to say, I don't want this gym membership anymore because I'm not using it, or, you know, my Netflix account hasn't been used in 6 months, and I can see that through the utilization. If you could see that sort of stuff and actually do something about it, that to me is where you start to see the value.
Yeah, absolutely. I think gone are the days where you could, you know, you had to fax in your termination letter to your gym to make sure that your subscription was done. I think I'd like to kind of pull that thread a little bit more. Latonya, while you've got the mic, let's shift through beyond CDR. So I'd like to talk still about CDR, but also about tech, FinTech, business as a whole. What's your ideal state? Like, where are we trying to get to? What do we need to do? What would you like to see? And what do you think we could do as an industry to give consumers the financial skills, I guess, to help them through the uncertain times that we're talking about, make the right financial decisions? And, you know, what's utopia look like in Equifax?
Look, personally for me, I think there needs to be a hell of a lot more competition in the banking sector. I think and that's just an obvious one, right? It's dominated by 4 banks. And then you have FinTechs who play around the edges with some great innovation. What we're starting to see at the moment is some collaboration and partnerships and innovation arms of the banks going out on a limb and creating some interesting ideas. But our FinTech sector needs to flourish just as strongly and should in some ways be independent. So for me, utopia is about seeing the rise of some smaller players out there that have really strong value propositions, and consumers are willing to take the risk of moving from their traditional banking environment to something that could be slightly a little bit more edgier. They may get a better rate, and they may also alongside that get a really interesting experience that helps them manage their money alongside it as well. Because it's definitely the point that smaller organizations can be a little bit more agile. So for me, that would be what I would hope, but also legitimizing some of the use cases back into the banking sector too. So using alternate data for credit lending is a classic one. And, you know, we're starting to see the likes of CBA and X15 Ventures go off on a limb and do some of this at the moment. But it's a pity that a big bank has to do it to make it, you know, valuable and actually accepted. I think that the FinTechs hopefully will get the funding that they need in order to prosper and create some really high value use cases using CDR as the mechanism.
Great answer. Thank you for that. Chris, do you want to add to that? What's your ideal state?
Yeah, it's I mean, the summary on the CDR point is really about that empowers customers to make better, more informed decisions with their own data. On this point, I think there is a big piece around education and financial literacy. There are lots of resources out there. Actually, we produce a lot of content. There are all sorts of ways to actually find out more. So that as I say, I think they're going to be more perversely, the more paying households feel, the more encouragement and probably incentive there is to seek that out. There's one point, we do a monthly sentiment tracker, and there's an interesting stat that comes to mind, which is just about, it's a cultural point really about our comfort with just talking freely about, you know, a whole range of finance products, you know, budget or debt or mortgages, and yeah, more than 40%, I think it's 43%, said they didn't feel they could talk freely about these products to or issues to family or to friends. So there's still a bit of a taboo, I think, to break down on a cultural point that I'd highlight. I agree with the innovation point hugely. Actually, we just did our we have an annual innovation awards, and there's a couple that come to mind. Bridget, kind of lending, they're one of the best lending innovation category, and they're really sort of it's a tech solution around short-term and bridging loans to help homeowners sort of leverage their equity to buy property before selling their existing home. So that's one example. What was another? Honey Insurance. They're looking at they basically put sort of smart sensors in the home to protect against, fire, water damage, etc., and theft. And they use those sensors to get a more active discount on their insurance products. So there's a good amount of innovation going on and around that. The one with a finder hat on, a lot of our time is there are use cases, like energy is a great example. CDR and energy means we'll actually get meter level customer data rather than relying on a customer having to tell us or guess. So you can imagine where that category might go as a sort of, imagine you're always on the right plan that is just absolutely suited for your needs. Brilliant use case there. And the other pain point for us is just trying to think a lot about time spent in anything you do, whether to refinance or you just think about the number of forms you may have to fill in. A large number of people speak to brokers, and I kind of, coming from a technology background, I feel those friction points are solvable by technology and really good UX. So I think things like that are going to be more where we're focusing our time. Things like chance of approval, with the data points that Tony talked about. Before I apply for a credit card or a loan, what are my chances? We've got more data points about that. That again makes it easy, I think, for customers to invest the time in some of these switching products as well. So I'm quite bullish about this. Actually, I think this is going to get better and better from a customer perspective, and technology and some of the regulatory topics that we've talked about being the enabler for that. So I'm actually quite excited by those opportunities. Actually,
it does sound like utopia. Just conscious of time, I know we've got some questions coming through as well. So let's go around the room. Let's break out the crystal ball. What is happening in 2023? I saw there was a question. This one might be for you, Richard. I know I was going to wait to the end, but there was a question about RBA interest rate pressure and when that starts to reduce. You might want to weave that into your answer. Sorry, but what are we thinking for 2023? What are the predictions? Richard, let's start with you.
Yes, I think Chris and Tony touched on some really cool things. I think it's the pursuit of seamless. That sounds a bit lofty, right? But you're going to see abstractions away from complex stuff that's really an old way of doing things. You're going to see more of that. Now, commercially, that might be with, partnerships and, you like the X15 type situations. Like Tony said, that could be, if the funding comes back in, it could be more FinTechs. But regardless, now we've got infrastructure in the economy, CDR, CCR, all those sorts of pieces. How do we use it, right? Bring on action initiation, by the way, right? So take the home loan. It's still unnecessarily long and a little bit friction full to refinance a home loan. I should be able to reprice my home loan every day if I wanted to, like that. Do you know what I mean? And I think you're going to see more and more ideas like great UX, integration, partnerships, leveraging, all under a really nice tight regime like CDR to produce those great experiences. So the pursuit of seamless is coming in. And the more you do that, the more you take anxiety out of, decision points, whether it's, new utility, car loan, home loan, you take that anxiety out. So it's an ongoing discussion with data rather than, an inquisition. That's, I think, what we're going to see more of now. It's not going to materialize fully in 2023. This is a 10-year journey we're going on, but you've got to keep the innovation in the economy. So you've got to keep the FinTechs participating. We've got to keep them partnering, working together to solve these problems so you can keep abstracting away the complex. In terms of interest rates, Chris, you probably would like to wax lyrical on that one, but March 23, that's it. Plateau done. I'm back down.
We're going to hold you to that. Thanks, Peter, for the question. We're going to hold Richard to that. Chris, 2023.
Yeah, more to come on the rate rise front. We do a RBA cash rate survey. There's almost 40 experts, and their view is in the sort of 3 to 3.5%, 3 to 3.25% next year. One thing on my mind is when that drops off, to sort of Richard's thought there. And, this isn't like the 1970s, right? We don't need the same level of interest rate rises to bring demand under control. We've got, and that's because, so there'll be a pinch point considerably earlier, just given that we're high leverage now with debt, with mortgages, etc. So it will start to drop off. The thing on my mind is that as a country, we don't have control over a lot of the supply side. And that probably means there's still going to be price pressures on that, that's the sort of worry. And it's almost like, when does that start to move? That's kind of out of our control in many respects. So that's the one call out for me. So interest rates going up, investment asset classes remaining under pressure, quite honestly. So stocks, shares, crypto, less attractive, continuing, CDR becoming a thing. I'm not sure if that's a hope or not, but I think we've reached a tipping point in industry participation now. I really do. So the next phase is consumer adoption, and particularly for us, action initiation, right access being the key. So that was a big tipping point in Europe when that rolled out. So I'm quite hopeful about that. And I think the final one is, businesses focused on. We've all got to up our game, not just for acquisition, but I think this really want to highlight the point of driving good value to your existing customer base and doing the right thing by them. And by the way, there's been lots of good examples of that as well, in terms of from large organizations as well as smaller ones. But I think really being proactive about that. And then the anomaly is what happens to, I think there are a number of businesses that have been over leveraged, and the cost of borrowing is going up. There's less supply in the market, given some of the moves on the bonds front. So there's less capital out there, and it's priced more highly. That at some point will put pressure on less efficient businesses, which is where we may see more pressure on some of those employment figures to start flow through. But I think we're probably at least 6-12 months away on that one. So that's the other kind of call out for me, as well. So there you go. A few thoughts, a little bit of hedging it in a few areas there, but wasn't quite as good as Richard.
We won't hold you to any of that, Chris. It's Richard that I'm concerned about.
There we go.
Tanya, what's your crystal ball saying?
She agrees with what.
Sorry, classic newbie error. I'll echo pretty much what's been said. So I don't see interest rates going backwards anytime soon. And talking with the people here at Equifax, their predictions are too that it will continue. They will continue to rise. My hope is open data does become a thing, to Chris's point, because it's clearly not. I mean, I speak to brokers, I speak to people in the auto industry. I was talking just yesterday to some energy providers, and they're really scratching their heads, to be honest with you, about value propositions still. So I can categorically say that we still need to prove the value propositions of how do you make money, as basic as that, across those industries. And yes, ideally, we want to see the outcomes for consumers. So like, forget about paperwork in the future, and opportunities like switching, Utopia, as you mentioned, Tanner, Utopia, moving from one provider to the other. Imagine if you could just do that at the click of a button from a bank to another bank. Like, that is the future. Whether we get there in 23, I don't sadly predict that, because action initiation is still, I'd say, a good 12 months away. But the energy sector's coming on board. Telcos are coming on board next year. So there's some hope at the end of the tunnel. Now, they'll go through the compliance exercise that the banks have been through, but they'll come out the other end and they'll go, hey, we can actually make some value and some money out of actually some strong use cases around becoming a data recipient as well. And, the flip side of this too is that in CDR, what you have is a strong proposition to acquire data. And if you're an analytics company like an Equifax, you can use that data. There's no sense. The fact is, it's actually got no personal information in there. So you can use that to derive further insights on how consumers spend, and then look at how does that drive businesses. Like a business like a bank or a healthcare provider might want insights on their consumers and their customers, and you can get that through CDR data. So there's all this above the line stuff, but below the line sits the actual analytical capability of consumer data as well. So there's a huge amount of opportunity coming into the consumer data right in 23. But in terms of just the economic environment, I still think we've probably got a little ways to go there, dare I say. And, the pressure on housing and affordability, those sorts of things, is still going to be a little bit tricky in the capital cities, particularly. But on the flip side, I can see consumers spending like crazy and still getting in their holidays because everybody's deprived of holidays over the last 2 years because of COVID. And I can guarantee no matter how much you have to pay for a trip to Paris, people are still going to go there.
I feel like you're just justifying that, Tonya, your own trip.
I think I would call out though that the signs for retail heading into Christmas though is beginning to drop a little bit. So there'll be, I think, watch this space on the travel front, but obviously go for it in the meantime though, Tonya. At just one point, because we've talked about quite high level themes, there's real practical things here, right? Check your credit score, look at what rate you're paying on your mortgage, credit card usage. Just there's some great balance transfer deals out there, that you can move over to and pay 0%. Just find it everywhere else. Just look at basics like that. Actually, we just launched a tool you might quite like. So you're streaming, you punch in the shows you want to watch, and it shows you the most cost-effective package for the streaming providers. Things like that. We can all, I think, make those dollars stretch a bit further if we need to in a real practical sense, and we might need to.
Yeah, and just, there's a lot of interest in the green, carbon offsets, all of that sort of thing. There's some really interesting apps that are being developed too to help people who are conscious of the environment and what we can do. And you can use data and understand how you're spending your money to offset your carbon footprint. So, yeah, I mean, ideally in the future, we'll see the rise of those sorts of things coming out.
Great. We're almost out of time, so I guess thanks are in order for the incredible discussion. I think we've obviously gone through a broad range of topics, and I feel like anyone listening has got a better understanding of, I guess, at least interest rates and the bill shock and definitely kind of where CDR is going in terms of educating our consumers and our customers. We have a couple of questions. To be honest, Richard, they're all aimed at you, mate, in terms of when are interest rates coming down and how much can I borrow? But there was, look, and we've answered a lot of these guys, but just on CDR, there's a question about the impact that CDR would open banking more specifically might have on the financial crisis, someone's called it. So just really briefly, do you feel like CDR will make it better, or do you feel like we're in for the long haul anyway? Chris, let's start with you just quickly.
There's a bunch of it will make it easier for customers to hopefully get a better service from the current providers using the data points that those incumbents have. That should be better for consumers, and it will also make it, if you're not happy or you decide want to go with a different provider, it will enable that switching to have less friction, be less painful, and therefore easier to do. So for me, it's really about choice and competition, and that at a household level will have some very, very direct benefits. I would say that those benefits can be unlocked today. There's nothing stopping consumers. It just maybe requires a little bit more legwork than hopefully the CDR will. The CDR will take a bit of friction out of that. But yeah, so.
Yeah, great. Richard, do you have a lens on that?
Yeah, I see it as it's all upside, consumer, businesses, FinTechs, but there will be an adjustment period. Take a consumer, even just getting a PFM app, right, having a look like, oh, wow, I spent more than I thought, or I'm not earning as much as I thought in this particular area. So there will be an adjustment period, but it is all part of improving financial literacy, making sure the inputs to key decisions in the economy, such as lending, are accurate and timely, and you will have a better, more functional economy in the long run and happier consumers.
Tonya, last thought on that?
Yeah, I completely agree. I think it's all upside with the CDR, but it's going to rely on volume, and it's going to rely on some really strong value propositions, instant credit checks, streamline, frictionless mortgages. There's so much opportunity, but it costs money to build and it takes time. So yeah, again, the future will show that once we get this sort of thing and visibility into the way we spend money and how we're doing it, these are all upsides in my mind. And to Rich's point, improves financial literacy, which is what we're trying to get to.
Yeah, agreed. All right. Well, thank you again to our panelists. Thank you and everyone who tuned in today. This concludes our webinar. I did want to mention that you will receive an email over the next few days with access to the on-demand version of the webinar. Other than that, thank you very much again for attending. Enjoy the rest of your day. Thank you.
Thank you.
Thanks a lot.